September 2008. Wall Street. Screens flash red. Phones ring without pause. Orders are canceled. Funds freeze redemptions. Banks stop lending. And then the unthinkable happens. Lehman Brothers files for bankruptcy. A 158-year-old institution, one of the pillars of American finance, too big to fail. But it failed. In that moment, the world realized something that had only been whispered behind closed doors. The global financial system was interconnected by a web of risks that almost no one fully understood. The crisis of 2008 was not just a recession. It was the moment modern financial engineering collapsed under its own weight. And the central question is this: how did a booming housing market turn into the worst financial crisis since 1929? To answer that, we have to go back a few years and follow the money. After the dot-com bubble burst in the early 2000s, the Federal Reserve aggressively lowered interest rates. Money became cheap. Credit became abundant. Investors searched for yield. And the housing market appeared to offer exactly that: steady appreciation, structural demand, tangible collateral. Buying a home was no longer just about living somewhere. It became an investment strategy. But the traditional mortgage model began to change. Historically, banks issued loans and kept them on their balance sheets, which meant they bore the risk if borrowers defaulted. That created discipline. Financial innovation changed that incentive. Mortgages began to be sold, securitized, bundled into instruments called mortgage-backed securities, or MBS. Thousands of loans were pooled together and transformed into tradable assets. Investors received monthly payments from homeowners. It was an efficient machine that converted debt into product. And for a time, it worked. Demand for these securities exploded. Pension funds, insurance companies, European banks, institutional investors all wanted assets that yielded more than U.S. Treasury bonds. MBS offered higher returns and carried AAA ratings, the same credit rating as the U.S. government. But here, the first distortion appeared. To create more securities, more mortgages were needed. To create more mortgages, lenders had to extend credit to more borrowers, including those who traditionally would not qualify. Subprime mortgages emerged, loans issued to borrowers with weak credit histories, unstable income, or high leverage. Many of these loans had adjustable rates. They started low, then increased sharply. Borrowers often relied on continuously rising home prices to refinance before payments reset. The system worked as long as prices kept rising. It depended on that assumption. Securitization did not stop with MBS. It evolved into more complex structures called collateralized debt obligations, or CDOs. Mortgage pools were divided into tranches. Some tranches had priority in receiving payments. Others absorbed losses first. The top tranches often received AAA ratings, even when partially composed of subprime loans. How was that possible? Mathematical models. Rating agencies relied on historical data suggesting housing downturns were regional, not national. They assumed mass defaults were extremely unlikely. But these models failed to capture the new reality: extreme leverage, global interconnectedness, and systemic dependence on rising asset prices. Another structural flaw existed. Rating agencies were paid by the institutions issuing the securities. The more structured products created, the more fees collected. Incentives were misaligned. Meanwhile, major investment banks operated with leverage ratios as high as 30-to-1. For every dollar of capital, they controlled $30 in assets. A small decline in asset value could wipe out their equity. Then came credit default swaps, or CDS, financial instruments marketed as insurance against default. Unlike traditional insurance, investors could buy CDS without owning the underlying asset. This allowed them to bet against securities they never held. It multiplied systemic exposure. The volume of synthetic risk far exceeded the actual mortgage market. It was a pyramid of interconnected bets, and almost no one had a complete picture of total exposure. In 2006, housing prices began to slow. Then they began to fall. Small declines at first, but enough. Adjustable rates reset higher. Subprime borrowers began defaulting. More homes returned to the market. Supply rose. Demand weakened. Prices fell further. The cycle accelerated. As mortgage-backed securities lost value, banks had to mark down assets. Capital eroded. Reduced capital meant reduced lending capacity. The interbank market began freezing. Banks no longer trusted each other. No one knew who was exposed to what. In March 2008, Bear Stearns required a government-supported rescue, but the defining moment arrived in September. Lehman Brothers was allowed to fail. The government chose not to intervene. The signal to markets was unmistakable. Not everyone would be saved. Panic spread globally. Markets plunged. Funds collapsed. Companies lost access to credit. The financial system went into cardiac arrest. The crisis did not remain confined to Wall Street. Businesses cut investment. Hiring froze. Layoffs surged. U.S. unemployment surpassed 10%. Millions lost their homes. Household wealth evaporated. Consumer spending contracted sharply. And because the U.S. economy is deeply integrated with the world, the shockwaves were global. European banks faltered. International trade collapsed. Emerging markets experienced capital flight. The world stood at the edge of a depression. Faced with systemic collapse, the U.S. government intervened on an unprecedented scale. The Federal Reserve opened emergency lending facilities, reduced interest rates to near zero, and injected massive liquidity into financial markets. Congress approved the Troubled Asset Relief Program, or TARP, initially authorizing $700 billion. Part of the funds recapitalized banks. Other portions stabilized institutions like AIG. In 2009, a fiscal stimulus package exceeding $800 billion aimed to support demand, employment, and economic activity. The measures were controversial. Critics argued they rewarded reckless institutions. Others maintained that without intervention, the economy could have spiraled into a depression comparable to the 1930s. What is clear is that the financial system stabilized. But trust took years to rebuild. In 2010, the Dodd-Frank Act was enacted. It sought to strengthen oversight, increase capital requirements, regulate derivatives markets, and introduce regular stress testing for major banks. Transparency improved. Capital buffers increased. Yet debate continues. Is the system truly safer or simply more complex? The crisis revealed a fundamental truth. Financial risk never disappears. It shifts. It evolves. When incentives reward excessive risk-taking and losses are socialized, fragility builds beneath apparent stability. Global interconnectedness means local failures can rapidly become systemic. Stability depends on confidence, and confidence depends on transparency, accountability, and aligned incentives. The 2008 financial crisis was not caused by a single mistake. It was the result of distorted incentives across the system. Banks pursuing short-term profit, rating agencies dependent on issuers, investors relying blindly on ratings, regulators trusting market self-correction, consumers assuming perpetual appreciation. It was a collective failure. It demonstrated that markets are not self-stabilizing when incentives encourage risk without accountability. The collapse nearly reshaped the global economic order. The system survived, but not unchanged. Because markets are built by people, and people respond to incentives. If those incentives remain misaligned, history may not repeat itself exactly, but it can rhyme. Understanding 2008 is not about predicting the next crisis with certainty. It is about recognizing patterns. And in finance, patterns matter. If you want to understand how major crises build, unfold, and reshape wealth, Continue exploring these financial documentaries, because understanding financial history is not simply about the past, it is about economic survival.